I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Good morning there, Jim. Good to be with you.
The stock markets look to be setting a certain kind of pattern. Can you tell us about it?
Well, yeah, there's been a terrific rush out of January. Of course, there was an equally terrific decline that really upset the establishment. December, January was a terrific wipeout in commodities, most stock groups, and lower grade bonds. Everything got under a lot of pressure. And as with these moves, it became very oversold, stabilized for a brief bit, and then moved up. And you recall that we talked about that we were looking for seasonal lows, let's sort of say around December into January for the base metals and for crude oil. And actually it was the plunge in crude oil prices, went down to 26, that really was upsetting people. And so finally all of those selling pressures there cleared, because you can have positive seasonal forces on base metals, copper particularly, out to around March or April. And we got that. Also, one of the contracts that was under a lot of pressure was the iron ore contract, because there was a lot of liquidity problems in China and too much iron ore. So that contract got hit. And then, as I say, the recovery on these rebounds were terrific. And on the iron ore contract, for example, in March, we got upside exhaustion readings on that. It was just absolutely terrific. And it's been correcting since. And the best sector in there, of course, were the precious metal side, where, like the senior index, the Hoye, it went from 99 to, what was it, 207 or 210, outstanding. And late in the play, silver suddenly popped up, and it had some great rallies in the silver stocks. And almost as good were the ETF for base metal mining stocks, EMX, did very well. So then what you want to do is look around and say, just how overbought is this, and how solid are the fundamentals? I know that the establishment was really quite confounded and perplexed with the weakness of January, and now that's all in the past, and everything is fine. There's been one or two more slightly positive readings on the U.S. economy, and so the orthodox side of the street is quite content again. I wouldn't say it's into the complacency where it was at this time last year, but everything's fine. I think a lot of the hobgoblins have gone away, no threats, that kind of thing. And again, the establishment is focused on the wisdoms of what comes out of the Federal Reserve through Janet Yellen, and I think they haven't got a clue what's going on. Central bankers these days don't have any advantage over what the street can produce by way of research, charts, understanding of different time series and that sort of stuff. There was, I guess, a time maybe about 40 years ago when they might have had some privileged information, but as far as research go, although they might have 500 economists working at the Federal Reserve, well, it was Greenspan said in 2011 that the problem with policy making through the Federal Reserve was that they really didn't have a good forecasting model, in which they don't. So, but nonetheless, let's just look at it as everybody's back to being happy again. But on the sectors we follow, there were a couple that were kind of weak. The financial side, bank stocks did recover. Broker-dealers did recover in the financial side, but it hasn't been too robust a market, despite that there's been some positive influences for the financial side. You've had a very nice narrowing of credit spreads, and there's been very little change in the Treasury curve over the last 4 weeks, so there was nothing plaguing the bank stocks except that they just rallied a little, but not too much. And as I said, the big action was in the golds and the base metals. So these have given overbought signals. And on the senior stock indexes like the S&P, we got what we call an inverse springboard, which is a sell in a flat or a declining market. The opposite of that is the real springboard. You can imagine what it looks like. And one of the key ones on that was we got back in October 2014, and then the stock market launched itself up right out until last summer. So there's a certain symmetry here where that was the last, October 14th was the last buy on the springboard model. And then with this rally now, which we think is topping, giving a springboard sell, that's the first rebound on the first decline from the top of the market last summer. So I kind of like the symmetry on it. And so this is important even when you look at the broad market, the New York Stock Exchange Composite, the symbol on that one, or the ETF, is NYA, and it gave the reverse springboard as well. So specific index like the S&P and the broad market like the NYSE have got the same signal. So you're never sure on one of these, Jim. It might take a week or so before it actually begins to roll over. So the way we look at it is that you need to have, on a weekly basis, a lower low than the week before. And we'll see what happens on that next week. In the fixed income, we think that the long-dated treasuries, they've rallied a bit here as the stock market stopped going up. But that TLT on that one, it can rally back up to that 135 level, and then we see what it is, sort of around 130 now. Junk did well, rallied, and part of the narrowing of spreads. And it's kind of a little overdone, and would expect junk prices to decline. By the way, we've been avoiding all lower grade yield products since June last year, when we figured that the world had a possibility of going back into another credit contraction, and that's been on. So to be clear on lower grade securities and credit spreads, this is just a rebound out of an oversold market. And so where the spreads have narrowed in here, it's also, you've got some favorable seasonal stuff on spreads that could be effective yet for a number of weeks, perhaps into May. So, but this is, on these things, on lower grade bonds, they're strictly for trading desks to trade and investors to avoid. I know that's hard to live with zero income, but the price risk in lower grade stuff has been serious and will continue to be. So
we'll have more with Bob Hoye right after the break.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band coming to West Vancouver Friday, May 6th at the K-Meek Center. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Bob Hoye. Bob, what's happening with precious metals?
Yeah, we glanced over those a few minutes ago, and just to go over it again, like one of the senior gold stock indexes is the Hoye, and it rallied from 99 back in January to, I think it was 210 or 207 was the high on that one, and that's an outstanding rally. The silver stocks did very well, and so we've got technical readings that are excessive. And with that kind of a gain, you know that it has to be corrected. And but it's quite likely. Well, this is what we were arguing in November, December, that as the precious metal sector, particularly for gold stocks, that it would likely be the end of a cyclical bear market that began in 2011, and the start of a new cyclical bull market. And when you get an index for the gold doubling, in a couple of months, this really makes you think, hey, this really is the start of a cyclical bull market. So there's also something intriguing in here, because the last time you had as sharp a rally from an oversold condition for the gold was in around October 2008, right in the midst of that crash. And the gold stocks did a similar bounce, huge one, while the big stock market still continued down, and it continued down actually until March, as we recall. Then the time before that you had one of these very sharp rallies was in the crash of 2001, 2002, and it was the same thing. You had the huge rebound in the gold stocks, and the bear market then didn't complete until later, well after. So the gold seemed to have a tendency to turn up beforehand. And then also, and I think we still are in a post-bubble contraction, so on the developing, or the next leg down for the bear market in the big stock market, it could be a depressant for gold stocks, but we would expect gold stocks to outperform the general market, and that has been the case for the last couple of months, and we think it'll be the case for the next few years. Now, this is distinctive from what's going on in the base metal stocks, which had a terrific rally. I think there's a little more than a correction coming into the base metal stocks. We don't think we're yet at a bottom or a new bull market for base metal prices themselves. So the next decline in base metal stocks could be more severe than what we see for the gold stocks. So, it's time to, we've been saying for 2 weeks, take money off the table in both resource sectors. And then, of course, we've got crude oil, which did a terrific rally. And you'll remember, in 2014, when we had a target for crude of either 37 on a bad market or on a really bad market, 27, and the low was 26, and then came in from an oversold and rebounded, so got up to 42 a few weeks ago. Then the other day, again up to that level, and it doesn't seem like it's going to break through. So I think crude oil can do another decline. Of course, it was up on having been very depressed, but also more recently up on this big meeting, Doha, where the major producers, or what used to be called the OPEC cartel, were going to talk amongst themselves, and they were going to talk about constraining production to help prices stay up. And that's the talk. It's in the market, and it's unlikely to happen. We're in a post-bubble contraction on commodities. It's not for good times, because like they used to say in the 30s with the farmers, they would, each year they were getting a lower price, then they wanted to grow more in order to have the same income. So they would plant from fence post to fence post, as was the saying. And of course, what you've got going on in the oil business is quite the same, and they're planting from fence post to fence post, or shall we say drill hole to drill hole. And with the change to in technology to fracking and sideways drilling, this is a new world for petroleum. But for the oil stocks, there's an interesting comparison. The base metal mining stocks effectively fell to a quarter of their high, and the oil stocks fell to a half. So there's still a lot of premium in the oil stock side due to perceived risks in the Middle East. And that was the case that held crude oil price itself up until a couple of years ago, when natural gas had showed the way down. So there was that premium in crude because of risk in the Middle East. And as it's a simple argument, but it looks like there's still a terrific premium in the oil stocks because of the Middle East. But we think as production expands around the world due to the new technology for crude oil, the Middle East will become less and less, and then you would find oil stocks trading down more towards what an evaluation that base metal would have. So we live, Jim, in very interesting times.
But I've noticed that now when there's trouble in the Middle East because of American fracking, we don't see the panic on this side of the water we used to.
No, thank goodness. So,
although I notice Saudi Arabia still gets a lot of attention because it does supply so much oil.
Oh, big producers, yes indeed, but I still think too much premium for that. So, and we're in a post-bubble contractionary world where commodities, well, in U.S. dollar terms, the saying we've had for a long time is that the senior currency, which is still the U.S. dollar, becomes chronically strong against most other currencies and most commodities for most of the time, and seems to be working out. The U.S. dollar itself here now is in a little basing pattern from which it could rally. Again, this could take a few weeks. This all fits in with the next leg down in commodities if we end up with a slightly firming dollar, which is possible.
Bob, thank you very much for chatting with us.
Yeah, Jim, good to be with you.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. You can forward questions or comments to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.